Welcome to Yahoo Finance Live. I'm Shauna Smith alongside Dave Brace. Let's get you up to speed on this afternoon's market action. Just about an hour to go in the trading day. You're looking at a mixed picture. The Dow off 77 points. S&P just fractionally to the upside here. The Nasdaq, the outperformer of the three, if we want to call it that, up just about 0.2% in terms of the sector action. Utilities, real estate, financials leading the way. The underperformers today, energy, XLE off just about 0.6%. Communication services off about 0.5%. Dave.
Thank you, my friend. Let's get you up to speed now on the latest from the Fed. The central bank's Beige Book just out, intended to characterize the change in economic conditions since the last report and give insight into the state of the economy across all of the Fed's dozen districts. Yahoo Finance's Jen Schomburger all over it. Jen, what are we learning today?
Good afternoon, Dave. Credit conditions tightened as banks tightened lending standards in the month following Silicon Valley Bank's collapse, according to anecdotal evidence across the Federal Reserve's 12 bank districts, that so-called Beige Book, though none of this at this point hurting economic growth. Several districts reporting that banks tightened lending standards because of uncertainty and concerns about liquidity from the period of March 9th through April 10th, which is right when SVB failed. Though the economy remained flat during that period, overall only 3 districts, Philadelphia, Richmond, and Kansas City, saw economic activity decline slightly, while the remaining districts were flat to slightly higher growth. Consumer spending flat to slightly down during that period. Now, on the job front, seeing a bit of moderation there. Several districts reported a slower pace of growth than seen in recent months, with contacts reporting that the job market is less tight as labor supply has increased. Also, companies were better able to retain employees. Wages moderated, but still remain elevated. On inflation, overall, prices rose moderately, but the rate of price increases appears to be slowing. Consumer prices increased on account of still elevated demand, as well as higher inventory and labor costs. On the producer side, there were declines in the prices of non-labor inputs and significantly lower freight costs in recent weeks, but producer prices for finished goods rose modestly, though at a slightly slower pace. So guys, all in, while credit has tightened, it's not hurting the economy right now. Job growth has moderated, but inflation still remains a problem. Fed officials will take all of this information into account when they look to set interest rates at their next policy meeting in 2 weeks. Back to you.
All right, Jen, thanks so much. Of course, we will be waiting for that. And also be sure to tune in tomorrow to Yahoo Finance Live, 4 p.m. Eastern Time. Jen will be having a sit-down here exclusive interview with Cleveland Fed President Loretta Mester. All right, let's get you up to speed on another big story this afternoon, and that's Tesla. The company is set to report its first quarter earnings results after the close. Yahoo Finance senior autos reporter Pras Subramanian is here. And Pras, what are we expecting from these results, and are they going to live up to them?
You know, we're watching price cuts, how that affects the margins and things like that. But on a top line revenue of $23.4 billion, down from last quarter. Adjusted EPS at 86 cents there a share. Also watching, net income is supposed to be down compared to last quarter and a year ago. Again, this is the margins potentially being compressed by these price cuts. So we're watching that. Secondly, I want to hear anything about demand. Is demand is it maintaining? Is it falling? Musk had said last quarter that demand was outstripping supply. But why are we getting these price cuts? In fact, we've had 6 price cuts since the start of the year. What's happening there? Finally, the Cybertruck. There's me in the Cybertruck right now in the picture there. So watching it here, want to hear if there's any.
You look good in the driver's seat.
Yeah, it's kind of, I think I look a little, my head's kind of scrunched there. But we're looking at whether they're talking about industrialization of that process production. Is it going to begin in second half of the year? How fast will these be coming out this year or potentially next year? So those are the kind of the 3 big things that I'm watching here.
I just want to put that graphic back up again. The Pras and the Cybertruck. We gotta drive that together someday. I hope I'm in the passenger. Can we put me in the passenger seat so I can just be all angry about that? Okay, so let's talk about these price cuts. How low do we think they may go?
I mean, who knows? We had thought that they were done cutting prices, and they're continuing to do so. I mean, the Model 3 now starts below, the base edition starts below $40,000 before any tax incentives, right? So, or any tax credits. So that's a big deal. The Model Y also dipping considerably to 47-ish, I believe. This car was $60,000 last year, right? Or beginning of this year. So we've seen tremendous price cuts for these cars. It's really kind of moving the needle in terms of getting people into EVs. I think that's the big, when you ask Tesla why they're doing this, they say, our goal is to kind of expand EV ownership. It's not about our margins, our profit, et cetera. That's what they say. But they got to be able to do this and still have a kind of hefty profit in order to maintain those big sort of valuations there.
No inkling of a demand issue here?
I mean,
there's got to be at the root of that.
I would think so. I would think there's something that they see that they need to cut. New competition, better pricing from competitors, who knows? But this is, I mean, maybe this is part of, this is, you know, their grand vision, their master plan 3 called for this, right? So are they doing that? I don't know.
We will see, and of course, we'll see how this is affecting profit margins here in just about an hour from now. Pras, thanks so much. Let's do a quick check of the markets. About 50 minutes to go until the close of the trading day. Look at the Dow off just about 92 points. Nasdaq and S&P, though, barely holding on to gains. We want to bring in Tom Hayes, a Great Hill Capital chairman and managing member. Tom, it's great to see you here. So certainly one of the big headlines this week has been the slew of earnings reports that we've gotten so far. Less than 10% of the S&P has reported. What's your assessment, your takeaway from the results that we've seen?
Well, as we know, Dave, the secret to happiness in life is low expectations, and the same is certainly true with earnings. We came into earnings season, very low expectations, negative 6.3%, so companies can just step over that bar. We've had 10%, just over 10%, 53 of the 500 components report earnings, and they're beating. 83% of the companies have beat earnings estimates. On average, over 6%. So we were expecting negative 6%. We're getting plus 6% so far. We're also beating on revenues, plus 62% beat on revenues. Average beat was about 5% on the top line. So with the expectations so low, I think there's some upside here.
Did you address that to me because I've been setting the bar low my entire career?
It's my secret.
I caught that, right?
I caught that too. I didn't know if there was a backstory that I wasn't aware of.
I think so.
I think so.
Well, we joked about it last time I was on. We joked about that, and
it is the story of my entire career thus
just
far.
laid it out
Set
there
the
for
bar
everyone.
low, you can leap over it easily. But I've also noticed in some of these earnings calls, perhaps some analysts are suggesting that CEOs are sandbagging a bit in these calls, saying, well, we're starting to see some softer numbers come in right up at the end. Are you seeing sandbagging as well?
Well, that's the number one job of a CEO, right? You know, set expectations low, beat expectations. I think the market did it for the CEOs this quarter. They're being cautious into the second half, but I think we're going to see continued beats. And the thing is, you know, everyone is really looking for more downturn in the market. We're seeing it in positioning. We're seeing it in everything else.
Why? Why is everyone looking for that downturn? Why is everyone asking about a recession? There's nothing indicating one.
Yeah, well, you know, it's been the tightening cycle. It's been aggressive. People are saying, well, the lagged effect, et cetera, et cetera, et cetera. But, you know, you still had that huge increase in money supply. You still had a 40% increase in money supply over. That takes a long time to work through the system. And if you look through to next year, and the market's going to start to discount, just like we discounted the bad news that we're seeing kind of this year, last year in the market down 27%, we're going to start to. We're moving up on halfway through the year here in the next couple of months. Market's going to start to look through 2024 earnings recovery, and that's why you're seeing some strength and some indecision. Even if we're nowhere near 248, which is estimates, even if we come down to 240, there's some upside here. And on a stock pickers basis, there's a lot to do.
So Tom, the street is clearly, from your perspective, too bearish. If you shouldn't be positioned, how it seems like traders have gone overweight bonds here, at least lately, and that was in the latest Bank of America Fund Manager survey, how should then investors be positioned for potentially that pop?
Well, look, now, you know, the stock market never tops when people are overweight cash and bonds. The stock market tops when people are overweight stocks on margin and there are no marginal buyers left. You've got growth expectations at the lowest rate since the 2009 lows, March 2009. People are more pessimistic than when the economy was shut down in March of 2020 and we didn't know if we were getting a vaccine. And you're also seeing they're taking less risk than they've ever taken all the way back to 2009. And pessimism toward the real estate sector is worse at the levels of March of 2009. You can't give real estate away. Now, looking back with 2020 hindsight, would you have wanted to be a buyer of residential real estate where all the problems were in 2009? Yes. Is this the time to be residential real estate? I don't know. But I can say we are seeing some opportunity in these beat-down REITs and the beat-down REIT sector, which no one wants. You can't give them away, and that's what we do. We like to buy things that are in distress that have high quality.
And in that sector, you do have a pick, and it is VNO, Vornado. Tell us why.
Well, this one you literally can't give away. The problem is it's been packaged in with all of these B and C class. So if you think about the mall problem 2, 3, 4 years ago, everyone said all these B and C malls are going to go out of business, and guess what? They were absolutely right. But the A malls, like Simon Property Group, they consolidated. They're busier than ever. They've got Lululemon. They've got Apple. Everyone's excited. I think the same is going to be true with commercial real estate. As the labor market loosens, more and more people are going back to the office. And when you look at Vornado, you've got the greatest buildings in the greatest city in the world. If demand for those fall in half, we have a lot more to worry about than commercial real estate. This is run by the best operator in the business, Steve Roth, obviously, and his proxies. But there's something to do here, and I just like to burden myself with the facts. So let's look at the facts. Since 2019, pre-pandemic, revenues are down about 5%. Funds from operation are down about 9%. The occupancy rate is down about 0.9% for the New York City properties. Like I said, Fifth Avenue, Madison Avenue, Park Avenue, Penn Station, the new developments, et cetera. But the stock is down 75%, and those divergences are where money's made.
But what about the leases, though, that are going to expire over the next year or two? That's a big concern there. What exactly happens to these buildings and some of the conversion that's already taken place with those empty office buildings?
Yeah, well, Steve Roth, look, if they didn't take him out on a stretcher during the great financial crisis, they're not going to take him out on a stretcher right now. They have been selling off buildings and raising cash over the last 24, 48 months, so they're in a good position to take advantage of the distress. But the demand, like you saw at the malls, for the highest quality properties, it's always going to be there from someone. And it's already priced in. We lost 16% book value per share since 2019. The stock is trading at a 40% discount to book if the entire thing was liquidated.
But the 10-city average on office occupancy, return to office, doesn't move, man. It is plateaued right at 49%.
Yeah.
It doesn't budge.
Yeah, because the labor, and by the way, that's in aggregate, okay, but at the highest quality buildings. So where Vornado's positioned, I think, no matter what, and as the labor market loosens, which we're starting to see because of all the tightening, people want to get face time, they want to go to work. You know, I've talked anecdotally to people that are laying people off, and candidly, the easiest ones are the ones that are working remotely, the ones that are in with the team and that are in the office. And as people get a little bit nervous about, you know, potentially losing their job as they see people getting laid off, they're going to want to be in the office. And I think you're going to see that collaboration, and you're going to see more and more people move back in. But to your point, we did lose a lot of malls during that mall cycle, but we didn't lose the best. And when we talk about Vornado, when we talk about Steve Roth, we're very, very interested.
We like your
By
conviction.
the way,
Courageous call.
People are scared about cutting the dividend. They already cut the dividend 43%. So at this stage, you're still getting a 10% yield at these levels. There's room to cut more if they have to. I don't think they're going to because they recently cut in the last 75 days. I think there's opportunity for upside here. It's not for the faint of heart, little volatility, but
no
some
doubt.
opportunity.
We like your conviction. Tom Hayes, good to see you, sir. Thank you.
Thanks for having me.
All right, just getting started here on Yahoo Finance Live. Still coming up, earnings season rolls on as Tesla gears up to report after the bell. We'll dive into those numbers as soon as they come out. And could President Biden's new executive order cut childcare costs for your family? A closer look at the order and how to address the soaring cost of childcare. Also, the Seattle Kraken winning their first ever Stanley Cup playoff game. We speak to the team's CEO on what it takes to run a fan-first franchise. Regional bank Western Alliance giving investors some good news this week, saying Tuesday it added $2 billion in deposits during the first 2 weeks of April, is sending shares soaring. Western Alliance currently up more than 20% today. Wedbush Securities upgrading the stock from neutral to overweight. The analyst behind that note, David Chiaverini, joining us now. David, good to see you, sir. Why the upgrade?
Yeah, you hit the nail on the head. Deposit trends were better than expected. The stock had been trading as if it was facing a significant bank run, and it did partially in the early days of March, but clearly it stabilized. It stabilized by 1 to 2 weeks after SVB went down. And as you noted, deposits quarter to date are up $2 billion. So, and then they gave guidance looking forward of $2 billion per quarter, and that equates to 20% growth annualized. So it does seem like the worst is behind the company.
David, are all the problems when it comes to Western Alliance, some of the fears out there, is that totally in the past, or do you expect maybe to see some of that fear creep back into the stock here over the next coming weeks?
Yeah, fear could always creep back in, especially when it comes to the banks in this backdrop. Looking at where the stock had been trading just as of yesterday's close, it was trading at 4 times our earnings estimate. So very cheap. And we felt that enough risk was kind of baked in, or bad news was baked in enough to that valuation that we were willing to, take a risk on upgrading it. But looking forward, we still haven't seen a resolution around First Republic. So we'll see how that goes. So that could be another, issue that could weigh on banks in coming weeks. But at least for the near term, as we go through earnings season, the theme so far has been less than feared. And I expect that to continue. Now, looking out to May and June, that's when the narrative could shift back to some of the concerns that have been facing the banks in terms of deposit costs, regulatory issues, and loan growth could also weigh on the group.
Yeah, I mean, you've got the price target up to 50 from 38, but this was a $75 stock 6 weeks ago. Is that indicative of how much damage was done by this banking crisis?
Yeah, it's a good point. For instance, they had peaked at their deposits mid-quarter at 61 billion, and they just put up that at March 31st, it came down to 47.5 billion, so down almost 25%. And then on top of that, you still have a very intense environment for competition around deposits. So funding costs are going up for Western Alliance and the overall banking industry. And I am concerned, I think bank investors are concerned that we're not fully out of the woods from a credit quality standpoint. So as the economy potentially slows, as banks pull back on their credit availability, it could weigh on credit quality, and Western Alliance would be in the mix there too.
So, David, you like Western Alliance. You also added M&T Bank, Regions Financial, New York Community Bank Corp. to that list of best ideas. Is the common thread there insured deposits, or what do you like about those banks in relation to Western Alliance?
Yeah, for all of them, they do have above average insured deposit levels. Regions Financial, they're up at 75% of insured deposits. Western Alliance is now at 73% insured deposits. M&T Bank, they already announced earnings earlier this week, and I would put it in that category of less than feared. Net interest income guidance was lowered to 20 to 23% growth for this year. They had been expecting 23 to 26%, so down modestly, but I think it was down less than what the market had been pricing in for them. So we are expecting deposits to stabilize for them. And then looking at their outlook for net interest margin, they've locked in a net interest spread of 3.6 to 3.9, down from 4%, even if interest rates were to plummet back towards the 1% level. And that theme is very similar for Regions Financial as well.
David, the Fed in the last hour out with the Beige Book, which reads in part, several districts noted that banks tightened lending standards amid increased uncertainty and concerns about liquidity. When will we get a sense that its coast is clear in terms of the crisis and its impact truly being felt and behind us?
Yeah, I think that's going to take a while. In fact, the Senior Loan Officer Survey, the next installment of it, will come out in the first week of May here in a couple of weeks. And I fully expect lending standards to show tightening in that survey as well. And I don't expect a loosening to occur until we get through the looming potential recession and this cycle. So I'm thinking we're probably 12, 18, 24 months away from a full loosening. Now, granted, a lot of consumers and businesses have significant cash cushions set aside, so that would be potential for a soft landing. But barring that, looking at how much monetary and money supply is coming out of the system, that could weigh on the overall economy and banks. But it could take a while either way you slice it.
All right, David Chiaverini, always great to get your perspective of Wedbush. Thanks so much for joining us. Well, coming up, we go around the horn for today's installment of Triple Play. Stick around for some of the top trending stories of the day. We'll be right back. It's time for a Triple Play. 3 stocks that we're watching in the final 30 minutes of trading: Morgan Stanley, Disney, and Redfin. Let's kick it off with Morgan Stanley, on track to actually close the day higher. It's kind of been seesawing throughout the trading day following its Q1 earnings results. Now, the big bank's equity sales and trading revenue was below estimates. Its profit was also off about 19% from a year ago, hit by a slowdown in deal making. Certainly a common thread among the big banks this quarter. Investment banking revenue also falling 24% on the earnings call. CEO James Gorman reassured analysts that he thinks that we are not in a banking crisis. He did, though, warn that there has been and may still be a crisis among some banks, but really distinguishing what is going on in the regionals compared to what is going on with the big banks today. It certainly was not all bad news here for Morgan Stanley. One of the bright spots in this report is its wealth management business. Revenue from that division rising 11% from a year ago, accounting for about 45% of total sales in the quarter. Ali, we know that this is a trajectory, that wealth management business is a focus here for Morgan Stanley, and also really boosted these results when you compare it to some of its largest competitors within the space.
Yeah, really strong results on that side of things, but it's just been a wild Q1 for a lot of these banks amid those rising interest rates, the ripple effect of SVB, also the outflows of deposits that we've seen. Morgan Stanley reported that deposits were down 3.7% from a year ago, 2.5% from the fourth quarter, and that's a trend we've seen for many financial institutions. But what also stuck out to me was a recession commentary from Gorman on the earnings call. He spoke about the possibility of a modest recession, warning that if inflation isn't tamed, interest rates could go much higher than people expected. He said that seems like an unlikely scenario at this point, but by and large, overall pretty positive. He said on a go-forward basis, the bank is in a strong position, and that seems to be the trend here. Cautiously optimistic, but optimistic nonetheless.
Yeah, I think if you characterize the whole sector, it's better than expected. We all have a note from Gorman who said he sees stresses in the economy, citing, no surprise, particular weakness in commercial real estate, which we are really beginning to learn just the beginning of what's ahead in commercial real estate, but actually added, it feels surprisingly benign, the stress in the economy, compared to what it could have been. So yeah, overall, better than expected, could have been a lot worse for the banking sector.
And we'll be talking real estate in just a minute, but moving on to my play, it's Disney, which unfortunately will soon not be the happiest place on earth for some of its employees. According to Bloomberg, the media giant is planning thousands of job cuts next week, which will include slashing 15% of its entertainment division. The cuts are expected to impact several areas within that unit, including TV, film, theme parks, and corporate teams. This coming as CNBC just reported ESPN will begin layoffs early next week. Yahoo Finance reached out to Disney for comment, did not immediately hear back. And although it's not 100% clear from this report, these cuts are likely part of Disney's larger effort to slash 7,000 jobs by the start of the summer. Iger had already said these layoffs will happen in 3 waves. This would be wave number 2. And of course, the main reason for this is profitability, right? Disney is looking to slash $5.5 billion worth of costs. The stock trading to the downside today, off about 2%, but very disappointing if you're these employees. Sad,
really, because we talk a lot about the investor side of these layoffs, but this is a real tough human story for thousands of employees. That this is, and not to lessen the impact of tech layoffs, but it is a decent environment. We're seeing turnover rate pretty good. 90 days, most tech employees are back to work. TV, theme parks, media, that is a very tough environment to be unemployed right now. So a sad personal story. I just want to add that there was another board meeting today for that special tax district, Reedy Creek, and that is far from over. That fight escalating once again, with that board now threatening several things: tax hikes, utility increases, and developing land around Disney's tax district. So this thing is far from over. And the chairman of the board, Martin Garcia, said it is shameful what Disney tried to do, alluding to that end around, which is pretty smart by Bob Iger, quite frankly. Ron DeSantis loves this issue, and he ain't letting it go.
He's not letting it go, and Iger's also not backing down. So it's going to be an issue, like you're saying, that's going to carry on for quite some time. Iger, a very, very busy man these days. When we talk about the fight with DeSantis, also the necessary cuts that he thinks are needed for Disney, especially within the streaming business, the media side of the business, to really turn the ship and their goal towards profitability. So we'll see whether or not Disney's able to deliver on that vision.
Have his hands full, and then Succession, and well, a lot to do there. My play is Redfin, the online real estate services company, reporting the median U.S. home price in March fell 3.3% from a year ago. That is the biggest decline in 11 years. Among the cities seeing the biggest drop, Boise, Idaho, down 15%. Austin, Texas, more than 13%. Sacramento and San Jose, California, both down more than 10%. And yes, those are all primarily out west. Redfin said it also saw new listings fall 23% in March, as higher mortgage rates forced both buyers and sellers to stay in their current homes. The Mortgage Bankers Association says the 30-year fix now at 6.43. That is well up. We will get the Freddie Mac number on Thursday. Redfin shares up 1% today and up 112% year to date, as we get some interesting news in the industry. But the price drop was the real headline here.
Price drop was a real headline, but I still think it's very uncertain when we're going to regain significant momentum within the housing sector, especially given the fact that the 30-year mortgage rate ticking to the upside. We had applications dropping 10% last week from the prior week. That was the biggest drop that we have seen now in quite some time. So we talk about the fact that people are stuck in their homes with those lower mortgage rates. They're not eager to sell. People aren't buying because of the fact that mortgage rates are so much higher than they were a year ago. So it's a tough predicament right now, and it's really tough to figure out where the housing industry is going to go, at least over the next couple of months.
And on top of mortgage rates, you had the SVB collapse that I think spooked a lot of potential buyers out there, slowed that momentum down. Redfin also noted that the dip in pending sales, a major contributor to these dips in prices, since if you have less buyers on the market, the sellers need to sell their homes for less. But a lot of uncertainty and a lot of unknowns as we
rates will continue to climb for a couple more months, I think, as well. All right, coming up, cannabis stocks have been under additional pressure this year. We discussed the outlook on the industry and what to expect for the market throughout the rest of the year. After the break, stick around. Cannabis celebrations planned across the country Thursday to mark 420, what's become a national holiday for the cannabis community. Investors in the industry, however, not so much in a celebratory mood. The three largest U.S. cannabis companies down between 50 and 60% over the last 12 months, with really no relief in sight. Let's bring in James Wilson to talk more about this. ETFMG cannabis research and banking expert as part of our ETF report brought to you by Invesco QQQ. Good to see you, sir. So what could be the catalyst? What does the next year have to hold for the cannabis industry and investors?
Well, like you mentioned, 2022 was a rough year for investors. There's a lot of volatility. There was super high expectations that at the end of last year we'd see some form of regulatory reform, and it obviously it didn't happen, and it just really took the air out of the balloon, and we've seen a result of it with the price performance. So 2023 is, we'll very likely see top line revenue growth. We're going to definitely see a realignment of expectations at the corporate level, where they're going to be less focus on absolute growth and more focus on really operational efficiencies, reevaluating various capital expenditures, and really also focusing on their core CPG business. Let's build their brand, new product forms to help expand the addressable market, things of that nature. So that realignment will help a lot. But more than anything, to really move the needle for the industry, we need to see regulatory reform.
Jason, what are the odds that we actually will see regulatory reform? Because Democrats, Republicans are so far apart on this issue. And at least when you look at where the talks ended and pretty much where they stand today, there hasn't really been, it seems like, much progress made inside DC.
Yeah, Democrats and Republicans aren't actually that far apart on it at all. What they're apart on is the extent of reform. And, we saw that last year. What we saw was, a co-sponsored Safe Banking Act bill that was, the votes were there in the Senate to get the 60 votes that were needed. Where the friction came, and ironically, was within, from what I understand, within the Democrat Party itself, where they were looking for more extensive reform. And that's really where we keep seeing the friction is. I think there's this feeling that if we only have safe banking, it isn't going to benefit the right groups of people that need to benefit. It's not going to benefit the small business as much. It's not going to benefit the minority. It's really going to it's not going to give the help where it's needed as much. So that's where the friction really lies to some extent, is how far to go reform, what's it look like. So there is bipartisan support. There is support on both sides of the aisle. That's not where the friction is. It's really getting alignment on what the right issue is. And, it's not a dead issue. We just saw the Small Business Tax Equity Act that came out. Whether it's going to be read, we'll hear it in the Republican-controlled House is a good question. But there is, it's co-sponsored by both sides of the aisle.
So bottom line, when do you think we could legitimately, let's forget about legalization, at best probably 28. When do you think we could see safe banking passed in the Senate? Is there any potential for this 280E reform that Congressman Earl Blumenauer is discussing? And that's really key for these businesses who cannot write off business expenses and pay an effective tax rate 2 or 3 times an ordinary business.
Yeah, getting rid of the 280E drag would be huge, especially for the larger MSOs. As you mentioned, their effective tax rate is egregious. And they are state legal businesses, and some of the states have already taken measures to correct that, but obviously at the federal level, it's still a problem. It's a good first step for sure. Whether or not we actually hear it makes progress, we'll see. It's co-sponsored by both parties, so there is a chance. It is very incremental reform. I suspect that if it actually does get passed in the House, the bigger question will be, again, whether we have the same problem we had at the end of last year, whereas we want to see the Senate come out with more expansive, more extensive reform. And that's where we could get friction again. So, if we can get it through the House and we can get it in front of the Senate, that could be a good first step, and open back that communication, gets a chance of getting safe banking or even safe banking plus back in again sooner than we might expect. But
and Jason,
we're running out of time for sure.
Yeah, and even the states that have legalized, which were currently, I think, 21 plus DC, the 2 biggest markets in the country, California and New York, which is still very young, but are plagued by the same problem and look like disasters instead of being role models for what other states should follow. We asked George Archos, the CEO of Verano Holdings, about their problems. Here's what he told us.
The whole point of putting legal operations into place is to make sure that our consumers have a safe, consistent product. And that's not happening. In California, there's so much gray market, black market. The government is not shutting them down, and it's very unsafe. And that's when you have difficult situations. And unfortunately, some of that falls on us, even though we're doing everything right. And now New York is doing the same thing.
How do we get it right? How do investors jump into this space when the 2 biggest markets have been an absolute failure to date?
Yeah, and again, it's that regulatory reform. And to your point, it's just, even without the legalization, we need some level of reform to allow these businesses, where the states have said it's legal, when we want it, is to allow at least proper banking, right? To get rid of the mostly cash transacted business, to get more support behind the enforcement. It's one thing to legalize, but you have to enforce the illicit market. We've seen it in Canada. It's a serious problem where almost half the sales are still in the illicit market. Without enforcement, it's legalization isn't as effective as it can be. So it's, everyone keeps dodging the issue. It's good that we're looking at reclassifying at the federal level. That's underway. That could take a while. We still may need Congress to help move that forward. But at the end of the day, it's got to be the whole package. It has to be, creating a level playing field so we get enforcement, getting the banking right. That's what's going to get investors back, and that's what's going to help the industry participants actually have, long-term viable businesses.
Indeed. Nonetheless, U.S. sales estimated north of $30 billion this year. Pretty solid number. Jason Wilson, good to see you. Thanks so much. All right, stick around and we preview what to expect from Tesla earnings with Ross Gerber on the other side of the break.
The next After the Call zeroes in on Tesla, ticker symbol TSLA. We're going to be tracking the tick by tick after hours when the earnings report drops. Brad Smith, Brian Sozzi.
I am locked in on if Elon Musk, the CEO of Tesla, is even going to be on this call. It is no guarantee that he will be, but he better be on this call. I need to know from him how much money Tesla made during a quarter where they've been slashing prices so people buy their really expensive EVs.
We've already got some of the delivery and production numbers to our benefit. However, the big question on where that margin, where the profitability is going to maintain itself and what the outlook for the company looks like, especially as they're netting some new contracts to make sure that they're building out more factories internationally to deliver on the electric vehicle demand right now. Got my gold bricks ready, just in case.
Yeah, I don't know what Brad is looking for besides gold bars. I'm focused on how many times Elon Musk mentions AI, that is artificial intelligence. Brad, I'm saying he's going to mention it 52 times.
I don't know why I have these gold bars here, quite frankly. He's really more focused on Dogecoin anyway. So it's not so much about the digital gold that Bitcoin is, even though Tesla did hold that for quite a while on their balance sheet. Maybe we get an update on if they're inclined to get back into that. But yes, AI mentions at least 7, for sure.
After the call on Tesla, Yahoo Finance. Be there, be square, be electrified.
Tesla shares moving to the downside here, off just about 1% ahead of the company's first quarter earnings results after the bell today. Profit margins are going to be in focus. The EV maker cutting prices for the 6th time this year, making that announcement ahead of these results. We want to bring in Ross Gerber, a Tesla investor, also Gerber Kawasaki Wealth and Investment Management CEO. It's great to see you again here, Ross. So, of course, the big question, one of the key metrics to watch in this report is going to be profit margins. What are you expecting to see? How big of a hit do you think Tesla could potentially take as a result of these price cuts?
I mean, it's so hard to call, because it's like they change prices like every, few hours and it's usually down. And we know that costs have come down with Tesla. But from what, I was told from Elon and Tesla was that it does take some time for costs cuts to sort of trickle through the supply chain. So we expect much lower input costs for Tesla as the year goes on, but certainly not in Q1. So, it's hard to get excited about the margin numbers. So we'll see. I'm trying to understand the logic behind all these price cuts. And certainly if I was going to buy a Tesla, and I would kind of be worried buying one thinking he might cut prices again next week. So, I'm just a little confused by the whole strategy at this point, and we'll see what the margins are, and hopefully they'll articulate what this strategy is.
Hey, Ross, you kind of alluded to this on Twitter, but what do you think the impact is from a consumer perspective when you see not just 1, 2, or 3, but 6 price cuts and how that impacts demand?
Right. So this is an issue that I don't think Elon's thought about, which is that buyers will actually not buy the car thinking that it's going to get cheaper. Like I talked to somebody who bought a car like 4 months ago and they paid over $60,000 for their car and they're quite unhappy. They're just really unhappy. And for a good reason, because the prices dropped 30%. So if you kind of think the price is going to drop, like why would you buy a Tesla today when they're going to be cheaper in 2 weeks or a month? And so it creates the wrong type of consumer behavior. Typically, when you run a sale, what you do is you say limited time only, we're going to drop prices by $5,000 for a month, get it now. That's typically how you market a product. So Tesla's gone into what I call negative marketing, where the CEO works very hard not to sell cars and people just buy cars based off price.
So, Ross, how worried do you think Tesla then is about the growing competition within the EV landscape, and how critical is that sub-30,000 vehicle from Tesla?
Well, I think Tesla's goal for the sub-30,000 vehicle is more relative to scale and becoming a little bit more like Toyota, where they're looking to serve the low and mid-end EV market in mass scale versus the high-end market, which is clearly they're seeding. So when you're talking about competition, you have to divide it into competition on price and competition on quality. And so in my mind, they're giving up the high end. And so they're really looking at a few key competitors, whether it's Volkswagen or the IONIQ is doing very well. I think it's a Kia or a Hyundai. And then you've got a whole host of other companies from Ford on through that are coming out with EVs that are decent. But the biggest issue is they've been unable to scale. And so really Tesla's biggest advantage today is that you can get a car today if you want to buy a Tesla, where a lot of the EV competitors haven't, scaled as efficiently, but that's changing. So Tesla has competitors here in LA. People are making those choices. And if you go to a charging station today, you'll see 6 or 7 different types of electric vehicles. And they're all quite good now versus they all used to be quite bad. So Tesla's going to have to accept this new reality as well.
Yeah, the competition is really catching up. We've talked several times about the Twitter distraction for Elon Musk, and here we are months later, and he's still very much consumed by the social media platform, talking about launching Truth GPT, whatever that is.
Right.
Is Tesla fully autonomous at this point? Do you feel like he's behind the wheel?
Well, one of the things I do want to separate is what's happening at Tesla and what's happening with Elon. And I was just at Tesla, and I think the team there is supremely confident and competent. And I think their business plan is excellent. I love the company. My biggest issue is marketing. It has a lot less to do with execution, the technologies that they're building, the future vehicles on track. So Tesla's a great company, but the fact that the CEO only works there, part-time is certainly a disadvantage to when Elon was 100% focused on Tesla. I mean, it's just there's only so much time in a day. But I think Tesla investors and the stock have come to terms that, Elon is sort of, I would say, a part-time CEO at Tesla, and the team at Tesla is quite good. And they have made me happier with the succession plan, getting JB Straubel on the board, promoting Tom Hsu, the head of auto production. So I think there's a pretty good team at Tesla, and they don't really need Elon there. It's not ideal, but they're doing a great job.
You don't think they need Elon at all?
No, I didn't say at all. But if they needed him, clearly Tesla would be not producing record amount of vehicles. But I think what it is Elon's management style would not conform with the style of all the other CEOs of the major companies I've invested in, who are 100% focused on that company, whether it's Bob Iger or Jensen Huang at NVIDIA. I can't think of any other situation like this that I've ever seen in business. I think it's a unique management style, and I think he's got really competent people running these companies in the most part, and that's the reality. But does that affect Tesla? Yeah, it does, and I don't think you can minimize the impact of the CEO, who's obviously a genius engineer, not really being there most of the time.
Ross Gerber, I've been spending this whole interview trying to figure out what that T-shirt is behind your left shoulder. What is that, man?
It's the GK Fund T-shirt. It's our Rebound Tour T-shirt. We started at the top of the market, so last year was pretty tough. So now we're rebounding hard. We've had a great year so far in our fund, and we highly recommend investing for growth for investors. We think the market's turning, and this is a great time.
Good answer. Play that guitar for us next time.
Yeah.
Ross Gerber, Kawasaki. Good to see you. All right. Coming up, breaking news from the Supreme Court over the abortion pill. We'll discuss on the other side of the break.
Breaking news from the Supreme Court over the abortion bill. Yahoo Finance health reporter Anjali Khemlani joining us now with the details. Anj, what are we learning?
So we know that the U.S. Supreme Court now just extended the stay, allowing basically the pill to stay on the market and be accessed. They are going to make a decision by Friday. That's when they've extended until just before midnight on Friday. So we are still sort of waiting for a decision to come down from the courts. Now, just as a recap, the pill that we're talking about is the abortion pill mifepristone, and that is one of two pills used in medicated abortion in early term pregnancy. The other one is misoprostol, which is untouched. And we know that the two makers, Danco Laboratories, which has the brand name, is the one that is engaged in this court case. And just today, Gen Biopro, the maker of the generic version, just filed a suit against the FDA, calling for the FDA to give it, basically go through a specified process before taking it off the market if the courts do come down asking for the ban. So a lot developing all in one day.
Such an important case. It has to do with FDA and their approval process, research and development for big pharma, and of course abortion access. So wow, that's going to be a big one, and I guess possibly come down over the weekend. In other news, Intuitive Surgical among the top trending tickers on Yahoo Finance on earnings. What did we learn?
So we know that they had a pretty interesting beat today, and that is good news. It's something that we kind of expected considering the trend we're seeing. If you recall, yesterday Johnson & Johnson saw a beat on their medtech segment. This follows suit with the increase in surgeries and procedures that we're now seeing as a comeback from the COVID era, if you will. So that's where they saw that. So just to go through some of the numbers and some of the interesting points, procedures are now up 26% in the quarter versus what Wall Street expected was 14%. And then some of the top procedures, you can see on your screen there, including bariatric surgery. That kind of popped out at me because, when we're talking about the weight loss market, it might be an interesting play to see how that goes over the year. But, analysts really bullish on this and really looking at not just the return of the procedures that are backlogged from the COVID era, but also return of staffing levels that are helping with an increase in procedures, as well as the company planning to increase the cost of some of its parts and accessories with its popular robotic surgery device. So all told, strong outlook for this company.
Indeed it was. Anjali Khemlani, thanks so much. Appreciate that. All right, coming up, we're counting down to the closing bell on Wall Street. Stay with us here on Yahoo Finance Live. All right, just a few minutes away from the closing bell. It's always time to bring in Yahoo Finance's Jared Blickery to break down today's market action. Hello, my friend.
Hey there, we're looking at a little bit of downside action except for the Russell 2000, but not a lot. And let me just show you what's happened in the month of April so far. This is the S&P 500, this is year to date, but we've only had one 1% movement day in the index this month, and that is very unusual to have some 13 trading days. Also, another thing that's really interesting that happened today, the VIX trended lower. It hit 16 and change here. It hasn't been that low since November of 2021. And importantly, it hasn't been that low since the first day of 2022, which was the highest day in the S&P 500. So volatility is right back down to levels that we saw before we started all this rate hiking stuff. So think about that. Utilities in the forefront today, followed by real estate, healthcare, financials also in the green, but that is a defensive setup right there. Communication services taking on the chin, 0.8% down, followed by energy, materials, and tech. And let's just take a look inside the Nasdaq, see what's happening with 20 seconds to go here. Amazon up 2%. Tesla, we're going to be bringing you those earnings after the bell. That is down 2%. Everything else in between, does it matter? Yes, in fact, it does. Just want to show you what's happening in China and also in the ARK Innovation. So in the disruption field, seeing some green, but in China, seeing some red guys. Looks like we actually got one more minute to the bell. My eyesight did deceive me there. So let's take a look at some of our leaders. We see regional banks. Those were some of the outperformers today, followed by transports. Bitcoin taking in the chin. That's the Baito ETF down 3.5%. But let's take a look at some of those banks and then the regional banks. First, here are some of the bigger ones. We're taking a look at Morgan Stanley earlier today, up 0.5%. But really, the regional banks have seen some action today. You take a look at WA. That's up 24%. Even FRC, First Republic, losing some more fund managers and wealth managers, doesn't matter. They are up 12% as well. So seeing a bit of a rebound in this sector. And with 10 seconds to go, I'm going to leave you with the travel sector so we can get a feel for what's going on. United up 7%, American up 2.5%, guys.
All right, Jerry, thanks so much for walking us through the biggest movers of the day. Let's do a quick check of how things settled. And we take a look. It's a mixed picture. The Dow closing off just around 77 points. The worst performers inside the Dow, Cisco, United Health, and Disney. S&P also just below the flat line as the final trades shake out for the day. The Nasdaq, the lone gainer, if we want to call it that, in today's action, closing up just 3 points. But we can take a look at the sector action. We did see some outperformance in utilities, real estate, financials among the biggest gainers today. Communication services and energy ending in the red, Dave.
Interesting. Disney down 2 on the layoffs. All right, let's take a look at some of the top movers of the day. Morgan Stanley closing up just fractionally, less than 1% on the day after first quarter earnings. The company beating on the top and bottom lines, but falling short of the street's estimates on equity sales and trading revenue, hit by a slowdown in, of course, deal making, as you might expect.
Yeah, it's something that we've heard from many of its competitors here over the last several days as we get these results. Profit, Dave, was off about 19% from a year ago. Investment banking revenue, that fell 24%. Wealth management business was one of the highlights in this report. We know Morgan Stanley has been placing big focus on the wealth management side of its business. Revenue there up just about 11%. So maybe part of the reason why we're looking at shares ending in the green today. Let's take a look at Netflix closing the day in the red, off just about 3% after reporting its first quarter results. The streamer missing on revenue for the quarter, a slight beat by 2 cents on profit, but the streamer really reporting lower than expected subscriber growth. Disappointing outlook here for Q2 in regards to revenue. And then, of course, some critical updates that we did get on the earnings call, Dave.
Boy, it's been an interesting ride for that stock. You remember after we saw earnings, it plummeted 12%. Then it opened positive this morning and now has fallen. And yeah, the big takeaway was the password sharing crackdown has been delayed. The estimates are about 100 million Netflix users are sharing passwords. Morgan Stanley estimates they can convert about 20 to 30% of those to paid customers. Time will tell about that one as we have pushed that off, maybe based on some of the pushback from consumers. All right, Fox News parent company, Fox Corporation, ending the day down about 0.5% after the news organization settled its legal battle with Dominion Voting Systems for a whopping $787 million. Fox has over $4 billion in cash, according to the latest release, but the media company not out of the woods yet. Another voting technology company, that's Smartmatic, is suing Fox for defamation for $2.7 billion in damages.
Yeah, certainly a historic settlement here when we're talking about Dominion. Now all eyes on what exactly this next suit is going to look like. When we take a look at Smartmatic, now they released a statement following this settlement with Dominion. Smartmatic said that they were going to, quote, expose the rest of Fox's misconduct. And then, of course, Dave, as I know you were following, Fox shareholders are demanding some of the records here from the company here in terms of the directors and executives, whether or not they properly oversaw the coverage of Fox News, because then, of course, that begs the question whether or not we could see potentially shareholder lawsuits down the line.
Yeah, Reuters reported that, and that leads you to believe there will be shareholder lawsuits at some point. We know based on some of the emails and some of the testimony that they're, not in the testimony because we had day one, but that there was some overseeing, there was some knowledge all the way up. Perhaps some heads roll. Brian Stelter, the media reporter, joined us yesterday for Vanity Fair, suggesting that perhaps the leadership at Fox News could be in trouble. But isn't it interesting, just on the surface, Shauna, $787 million. That is historic in terms of defamation, and the stock drops 0.5%. Tells
Which is
you that
shocking.
Is nothing.
Nothing. And that was actually a little bit, I was trying to, yeah, which caught me off guard a little bit. I thought that it was going to be a much bigger impact to Fox when you take into account the size of this settlement, what that means here for earnings down the line, what it means for a profit potentially here at Fox, at least for the coming quarters.
Yeah, and if you expand on that, perhaps they settle for $1 billion, maybe they only stock drops a point. But the suggestion is maybe that Smartmatic case isn't until 2025, at least according to some Fox officials. All right, Apple CEO Tim Cook meeting with Indian Prime Minister Narendra Modi today after the opening of Apple's first retail store in Mumbai on Tuesday. Cook posting this photo to his Twitter account. The high-profile meeting is part of a wider strategy Apple is pursuing in India. Yahoo Finance's Ali Garfinkel here with those details. Hi there, Ali.
Hi, Dave. So to say that this is a big week for Apple in India is almost understating it. Remember, that first retail location in Mumbai was inaugurated by Cook himself, who then, of course, went on to meet with Prime Minister Modi. Now, this also comes just a couple months after Apple announced plans to move 25% of its iPhone production to India. And Cook himself has actually talked about being really bullish on the country. I'd love you to take a listen to this piece from an earnings call back in February, where Cook spoke about how he's thinking about India. Take a listen.
We actually did fairly well through COVID in India, and I'm even more bullish now on the other side of it, or hopefully on the other side of it. And that's the reason why we're investing there, with bringing retail there and bringing the online store there, and putting a significant amount of energy there. I'm very bullish on India.
So for Apple and tech at large, India does look like a really good market. And part of that is actually just that total addressable market population. India is in the process, or already has possibly, according to the United Nations, surpassed China as the world's most populous country. That said, India isn't exactly a slam dunk, easy hole-in-one. It's important to kind of remember that there are supply chain and financial infrastructure challenges in India, so it's not necessarily an easy climb from Apple for here. They also have a famously complicated bureaucracy, so that governmental involvement and governmental buy-in for Apple and for tech is going to be key. I think it's also important to just zoom out here a little bit. I had one source, a senior fellow at Brookings named Daryl West. What he said to me was, one of India's best assets is that it's not China. So as much as this is about India, Dave, I think it's also important that we're reflecting back. We're seeing reflected back at us a changing geopolitical landscape.
Fascinating times ahead for Tim Cook and Apple. Ali Garfinkel, thanks so much. Appreciate that. All right, tech layoffs piling up this year, and Meta is adding more to the list. Yahoo Finance anchor Diane King-Hall joining us now with the details. Hello, Diane.
Hello. Well, the hatchet coming after Facebook, Meta's workforce. I mean, and what does this mean for Meta employees across the board? We're talking about Facebook, WhatsApp, Instagram, and Reality Labs. Heavy job cuts have arrived again. As for the actual numbers, now Meta didn't give us an exact count when they reached back out to us, but they referred us back to a post last month, which signaled that this was coming down the pike. It was from CEO Mark Zuckerberg. I'll read a bit of it for you. He said, quote, "We expect to announce restructurings and layoffs in our tech groups in late April and then our business groups in late May." So obviously more coming. In a small number of cases, it may take through the end of the year to complete these changes. Overall, we expect to reduce our team size by around 10,000 people, end quote. Now, you may recall late last year, the company did a big round of year-end cuts in November, slashing some 13,000 jobs. Zuckerberg calling it this year the year of efficiency, but employees are calling it anything but that on social media. They're sounding off, whether it's LinkedIn, et cetera, people reflecting on their time. They're going through a plethora of emotions, human emotions, grief, sadness, et cetera. I even saw someone reflecting on, though, optimism, clearly optimism for the future. So far, the affected employees seem to be in fields like engineering, graphics, and gameplay development. Now, interestingly enough, you usually see stock reaction positively to news like this because it's typically, investor reaction is like job cuts coming, is profit preservation. But Meta actually traded lower on the day, falling about 1%, trading counter to the broader market action. But in general, this is the sign of trends that are happening in the tech sector. Companies after companies slashing their workforce, whether we're talking about Amazon, Google parent company Alphabet, Microsoft, Salesforce, we could go on and on, Dell, Zoom, and who could forget Elon Musk's baby, Twitter, where we saw some 80% of the workforce slash. And if we're keeping a tally this year, there have been more than 170,000 tech cuts. That's according to layoffs.fyi. And 2023 has already outpaced 2022 in terms of these dramatic cuts we're seeing in the tech sector. Obviously, we're going to see more. I mean, Facebook, or Meta cueing that more to come in May.
Yeah, the year of the efficiency is one thing, but showing growth is another. And they missed revenue 3 straight quarters. It's a big report next week. They report earnings.
That's right.
Diane, nice to see you. Thank you.
Excellent. Thank you.
All right, we have some breaking news now. Tesla earnings are in, and Shauna has them for us.
All right, Dave, we're looking at the stock under some pressure here after hours, not by much, though, off just about 1% here. Gross margin coming in later than expected, 19.3%. The estimate was for just over 21%. Also, another big headline, free cash flow coming in at $441 million. Now, the estimate was for just over $3 billion, and it's also a reduction of 80% on a year-over-year basis. When it comes to the top and bottom line numbers, a miss there on both. Revenue, $23.33 billion. That was a slight miss there for Tesla. EPS of 85 cents, also just short of what the street was looking for. When you take a look at what Tesla is saying in this release, they're attributing some of the quarter-over-quarter slowdown to, quote, volatile weather and other factors here. We have Brad Smith at the desk digging into this report as well. And Brad, another big focus of this report and of this earnings call potentially is going to be the updates on the Cybertruck. And at least the headline in the earnings release is that they are on track to begin production later this year.
Yeah, forget when Lambo, when Cybertruck is the question that a lot of investors have been asking Elon Musk at any update that they can get. And for at least what they're saying right now, they're on track to begin that production later on this year. Now, what's also noteworthy here is the fiscal year production target that the company is talking about. 1.8 million vehicles is what they're expecting. And the estimate was actually for 1.84 million vehicles. That was the consensus estimate. You'll remember in the previous earnings call, Elon Musk had talked about, hey, this could even get up to 2 million, quite frankly. And so when he put that target out there, you saw the stock price react during that earnings call, continue to tick higher. He continued to talk about something that perhaps we'll get a little bit more color on as well, which is this broader economic environment and the outlook that Tesla finds itself especially at a time where they've already initiated so many price cuts, even just before this earnings call and this earnings release and period, even though we knew what the production numbers were, we knew what the delivery numbers were for this most recent quarter. It was just a question of where that revenue would come in line at and where the average selling price and at what margin base that average selling price would hit at as well. But again, this is an economic environment where they're going to have to be responding to the consumer demand at the price levels that are going to be actually engaged with from the population that's looking to get into an EV. The EV landscape still only represents about 6% of the total car and vehicle market here. So that's important to remember. And that's what's really talked about within the growth scaling up for a company in Tesla and many of the other automakers as well, and Ford, GM, the US legacy automakers here as well.
You think we'll get news about the sub $30,000 Tesla that has been long whispered about? Because really that's Chevy's signature advantage in the EV space. That Bolt, they sold about 20,000 of them in the prior quarter. And that was a huge number that they put on the board. And still not a whisper about it from Elon.
If you ask Tesla, they were already able to do that based on some of the tax credits that they were able to roll out many years ago.
Plus, yeah.
Exactly. And so if you ask them, they would say, well, we already accomplished that. However, if you're looking at where they are really bringing about some of the production efficiencies here, 75% of the Model Y, that SUV, is really just the Model 3 in itself. So those production efficiencies driving down the cost, at least to get the cars off of the production line and perhaps into delivery mode, I think that's going to be key. They're going to continue to upsell that. And then going forward from here as well, even as we hear about some of the other models that they've teased, I think that's where a lot of the investors are really hanging the hat on what the growth could look like. Because if you're just to kind of look under the Casper-like sheet that they had put over them in their investor day, then you would summon, okay, maybe it's a Jeep-like or a Bronco-like type of model or something like that. I mean, that would appease a lot of people out there.
All right, now we're talking.
It would appease a lot of people, but even when you take into account the models that they have right now, the Tesla Model Y, there were some impressive stats within this report. It's the top-selling vehicle in Europe during the first quarter. In the U.S., it was the best-selling vehicle, excluding the pickup category. That's a pretty big category to exclude, but still, it really shows the Model Y, the sale numbers there, the traction that they are getting, the fact that these price cuts really are working, it seems, to some extent, with some of the consumers out there. So again, impressive numbers overall when it comes to the Model Y, but still a miss on both the top and bottom lines, a miss there on margin, which we know was so closely watched here within this report, obviously, is one of the big reasons why we're looking at shares off nearly 4% now.
You're hanging out with Saz for after the call? Is that what we got?
I am. We're going to pay a little more attention to this average selling price. That was a reduced average selling price year over year, too, that Tesla noted within this report.
Awesome. We'll be watching that after the call. Sazi and Smith. Brad Smith, good to see you, my friend.
Sounds like a law firm, yeah.
It does.
An impressive one at that.
You can defend me someday. I'm sure I'll get in trouble.
Oh, no, we don't.
Yeah,
Thanks,
we'll
take your
that,
business.
actually.
Yes.
All right, guys, let's get to IBM reporting their first quarter results. Ines Ferre has that for us. Ines.
Guys, so far the street likes what it sees. Mixed results for the first quarter with adjusted earnings per share, a beat coming in at $1.36. Revenue coming in at $14.25 billion. The street was expecting $14.33 billion. So a slight miss there. Free cash flow, though, that was a metric that the street was going to be looking at. And IBM says it still sees full year free cash flow at about $10.5 billion. Street estimates were for $10.28 billion. And then just going over a couple of highlights, software revenue was up 3%, consulting revenue up 3%, infrastructure revenue down 4%. Arvind Krishna, IBM's chairman and CEO, said our first quarter results demonstrates clients continue turning to IBM for our unique combination of an open hybrid cloud platform, enterprise-focused AI, and business expertise to unlock productivity and drive efficiency in their operations. The stock up in after hours more than 2%, guys.
Great job, Ines Ferre. Appreciate that. The latest from IBM's earnings. All right, coming up, we dive more into the numbers coming in from Tesla. Stick around.
The next after the call zeroes in on Tesla, ticker symbol TSLA. We're going to be tracking the tick by tick after hours when the earnings report drops. Brad Smith, Brian Sazi.
I am locked in on if Elon Musk, the CEO of Tesla, is even going to be on this call. It is no guarantee that he will be, but he best better be on this call. I need to know from him how much money Tesla made during a quarter where they've been slashing prices so people buy their really expensive EVs.
We've already got some of the delivery and production numbers to our benefit. However, the big question on where that margin, where the profitability is going to maintain itself, and what the outlook for the company looks like, especially as they're netting some new contracts to make sure that they're building out more factories internationally to deliver on the electric vehicle demand right now. Got my gold bricks ready, just in case.
Yeah, I don't know what Brad is looking for besides gold bars. I'm focused on how many times Elon Musk mentions AI, that is artificial intelligence. Brad, I'm saying he's going to mention it 52 times.
I don't know why I have these gold bars here, quite frankly. He's really more focused on Dogecoin anyway. So it's not so much about the digital gold that Bitcoin is, even though Tesla did hold that for quite a while on their balance sheet. Maybe we get an update on if they're inclined to get back into that. But yes, AI mentions at least 7, for sure.
After the call on Tesla, Yahoo Finance, be there, be square, be electrified.
All right, for a deeper dive on Tesla's earnings, we're joined by Ron Yevsikov, Guggenheim Securities Vice President of Automotive Equity Research. Good to see you, sir. So, quick look at it. Net income, $2.51 billion. That's down 24% from last year. What jumped out to you on this latest report?
Yeah, I think investors mostly were focused on the gross margins ex credits line, which looks like it came in maybe about 200 basis points light of where the street was this quarter. I think the other thing that's notable in the release is the free cash flow. There was some risk coming to this quarter with Tesla messaging things like captive financing and a bit of an accounts receivable, accounts payable unwind, as well as inventory build that weighed on free cash flow. But overall, I think those are the two major highlights at first glance, at least.
So, Ron, with all that then taken into account, I know you got a sell rating on the stock. Considering the fact that we are seeing a pretty considerable slowdown quarter-over-quarter basis, do you think there's more downside risk than ahead?
Yeah, I think the issues at this point are proving to be pretty structural, at least on the pricing side. The latest U.S. price cut was pretty surprising, I think, overnight, just given how quickly it came after the price cuts earlier this quarter. So I think that shows that our data supports this, that there wasn't much stimulative impact from the price cuts earlier this month, and they had to take an additional roughly $3,000 off the Model Y and $2,000 off the Model 3.
Yeah, speaking of those price cuts, we spoke with Ross Gerber, an investor in Tesla, also the CEO of Gerber Kawasaki. He had an interesting perspective on those price cuts and ultimately their impact. I want you to listen quickly.
Buyers will actually not buy the car thinking that it's going to get cheaper. Like I talked to somebody who bought a car like 4 months ago and they paid over $60,000 for their car and they're quite unhappy. You know, they're just really unhappy. And for a good reason, because the prices dropped 30%. So if you kind of think the price is going to drop, like why would you buy a Tesla today when they're going to be cheaper in 2 weeks or a month? And so it creates the wrong type of consumer behavior.
So Ron, from a demand perspective, are these price cuts backfiring?
I think they don't really have another tool to use is the problem. So I don't think it's per se backfiring. I think they're backed into a corner. They've put a lot of supply in place that needs to find a home. And the only tool they really have is cutting prices. And you've seen it work in China to a degree, and you've seen it work in the US. I just think the stimulative impacts of the price cuts has been waning with each incremental cut. And I do think it's true that if you are a prospective buyer, you are worried about the residual value of your vehicle. And if that is cut right after you buy it, it does leave a sour taste in consumers' mouth.
And certainly global inventory rising to 15 days, up from 13 days. You think that might be a little bit concerning there. Ron, when you take a look at the Cybertruck, there's lots of talk about the Cybertruck, of course, looking for updates here in this release. The one line that they did give was that it's on track to begin production this year. Is this at all important to the investor story, or how big of an impact this could maybe have on Tesla, given the fact that maybe they are struggling a little bit with demand for its other vehicles?
Yeah, I think it's really important. During our discussions with investors, I think the focus really is on what price point Tesla can deliver for this vehicle now. Obviously, a lot of things have changed since Tesla first unveiled the Cybertruck. And so I think the ultimate price point that they can deliver for this vehicle, I think, is called $60,000-$70,000 would be not as meaningful to the company. If they can deliver something under $60,000 for the Cybertruck, then you're starting to talk about a much more meaningful TAM, and pickups obviously are a large profitable segment, particularly in the US.
What could sway you? As Shauna mentioned, you're on the sell side of Tesla. What could convince you otherwise that there is, in fact, some upside at this current price level?
Yeah, I mean, it's tough until pricing bottoms, because we are more than $1 below street EPS estimates next year. And I think with recent price cuts, if anything, numbers are biased lower for the street, at least. And Tesla's trading at north of 40 times our estimates for a stock that, when we look out on our fiscal year 24 estimates, won't really have grown EPS for 2 years. I think free cash flow is a risk in the near term, as Tesla talks about captive financing and things like that to grow the business. There's no valuation metric you can point to. When we talk to bulls, I think it's more about, if you want to DCF and go out 26, 27, or even 2030, and kind of dream the dream on what this business could look like, it's a different argument there. But I think on the next, call it 2+ years of earnings until the Model 2 is a growing and profitable platform, there's not a lot of earnings growth here.
All right, we're looking at shares off just about 3% in after-hours trading. Ron Yesikov of Guggenheim, weighing in on Tesla's results. Thanks so much for joining us. And of course, be sure to tune in Yahoo Finance after the call, where Brian Sozzi and Brad Smith are going to be breaking down Tesla's biggest headlines from their earnings call. That gets underway at approximately 6:30 p.m. Eastern Time. All right, coming up, a recent survey showing that younger generations are canceling their streaming services and are spending more time interacting with friends online. We discuss the latest media trends next. Streaming giants are doing all they can to fight for viewers, but a new survey out from Deloitte showing that streamers may be in for some trouble, and that's because subscription fatigue is real. Now, Yahoo Finance took to the streets to find out what people are watching and whether or not they're paying for these services themselves. Check this out.
Right now, I'm watching the Powerpuff Girls, but I don't really got like a favorite thing. I barely use it.
Netflix is pretty good, but I mean, I don't watch it that often, so I'm probably not the best person because it's mostly for the kids.
No, I use someone else's. I use my brother's.
Would you ever pay for your own account?
No.
No, she will not. All right, well, here to talk the latest in the digital media trends, we want to bring in Jana Arbanis, a Deloitte telecom media and entertainment sector leader. We also have Jeff Laux. He's Deloitte's Center for Technology, Media, Telecommunications Executive Director. Jana, let me start with you because it's clear from the survey that you guys just put out, people aren't afraid to cancel some of their subscriptions. We just heard it from some of the people that we asked on the street there. Who is canceling and why? Is it all because of cost?
Yeah, it's a great question. In fact, I think what we see and what you saw on the slide is that actually, in fact, all generations are canceling at different rates. Across the board, we see about 44% churn. That means someone is canceling a subscription or canceling and adding a subscription in the last 6 months. We also see, as you double click into that our younger generations are turning at a much higher rate, 62 and 57% for our Gen Z and millennials. That's a significant number. And yes, I think they are worried about costs. In fact, millennials are the ones that spend the most on streaming video. And yet they're the ones that are turning at the highest rate, which essentially means they're looking for the most personalized portfolio of streaming services, getting the content they want when they want it, but at the price that's not too high that they're willing to pay.
Wow, Jeff, 62% churn rate for millennials. That is a concerning number if you are a streamer. What surprised you in those numbers we just discussed?
Well, there are a couple things. Millennials were the ones who ushered in the streaming revolution to begin with, right? And they do have more streaming subscriptions. But right now, they also have more financial obligations. Millennials, the oldest right now, are 40 years old. So things like inflation, things like having 4 or 5 subscriptions are weighing them down. And what they're starting to say is, look, I don't let the tap run all the time. I'm just going to turn that tap off when I don't need it, and I'll come back to it when I do. So they're just starting to balance their costs by turning these services off and then returning to them when they're ready. And that's something that we call churn and return. We found pretty high numbers overall, I think around 25% for those who said that they had a service, canceled it, and then returned to it within 6 months. And when they do that, they're managing their costs, but the profitability for the streaming suffers.
Jana, when it comes to why people are still staying subscribed, those that aren't churning, those that aren't canceling their subscriptions, what are they looking for and how does that vary based on age, did you find in the survey?
Yeah, I mean, at the end of the day, what people are looking for is really compelling, unique content. That's why people sign up. It's not necessarily cost. It's really about trying to find really great content that speaks to them. So I think that runs the gamut from generationally speaking. I just think that more consumers who are in our younger generations are a little bit more digitally savvy. In fact, one of the findings from the survey was just that our younger generations are really looking for a tapestry, frankly, of media. They are interacting not only with different streaming platforms, but also with user-generated content, with gaming, and they want to toggle between those, and they can do that from the same device. And so they actually want that like interconnectedness. And in some cases, we're seeing similar IP or franchises cut across these different forms of media, right? So we have a viral show that then launches, video gaming, and some of that hype and buzz is actually created through social media. So I do think there's an opportunity to really bring these different media types together and amplify and create more buzz for streamers through these different channels.
Jeff, what's that one thing, that thing that they can perhaps turn the knob up if they're a streamer and bring in more consumers?
Well, I think there are a couple things that they can do. One thing is to be where their consumers are. So especially if your younger consumers are playing video games, they're on UGC. Well, thinking about UGC and social, how can you end up promoting your TV shows and your movies so that you develop some viral buzz there? I think some of the better ones are doing that right now. you can also think about how you can extend your intellectual property and take advantage of some of that interconnection that Jana was talking about. So, you know, many gamers want to see a TV show or movie of their favorite game. Well, how can you end up tapping into that and producing that? And then, you know, the other way around, sometimes people who, you know, love a movie, maybe they will want to play a video game. And so whether you're developing that yourself or you're partnering with others, you know, can you end up taking advantage of this flexible fandom that people have? You know, they like it on the video game, they want to see it in TV, or the other way around.
Really interesting report. Jeff Laux, Jana Arbanis, both from Deloitte. Appreciate that. All right, the cost of childcare up 26% in the last decade, but President Biden wants that to change. We've got the details on how on the other side of the break. If you want the best return on the Treasury Department's inflation-protected I-bonds, you might want to get on it quickly. LendingTree senior industry analyst and DepositAccounts.com founder Ken Tuman predicts annualized I-bond yield will fall from 6.89% to 3.79% for the period from May to October. Yahoo Finance senior columnist Carrie Hannon joining us now. Nice to see you, Carrie. So why should people utilize I-bonds, and how do they compare to other safe investments?
Yeah, thanks, Dave. What is happening is I absolutely love I-bonds for a couple of reasons. They're government-backed. You're guaranteed to earn interest for a 30-year period. They're tied to inflation, so you're going to keep pace with inflation. And you're free of federal, of local and state taxes when you do redeem them, and sometimes federal taxes if you use them for higher education. This is a pretty good combination of sweeteners there. Now, it works. It's kind of interesting. They're very easy to buy. You go to Treasury Direct, and you can buy them in increments of $25. There's no fees. But how these work, Dave, is kind of, it's a little confusing. The rate is set by, there's a fixed rate and a variable rate. So the variable rate adjusts every 6 months. So in November and May. And what happens then is it's tied to the inflation rate, the consumer protection, so you're looking at these rates and you think from, the consumer price index, where are we going? So yes, inflation has dipped down. I mean, in the last year or so, there's been a party with these I bonds. Everybody wanted that high rate because the other investments like your savings accounts and your CDs and your money markets were paying less than zero at times. No, I'm kidding, less than 1%. They were very, very low. Now these have started to come back up recently, and now we're seeing the bonds are going to adjust down. But why it's still a good time to buy, if you can buy them before May 1st. The interesting thing is that 6 months, your interest rate is guaranteed from the day you buy it for the next 6 months. So conceivably, you can hang on to that higher rate, that higher variable rate we discussed for the next 6 months, and then the lower rate will kick in for the next 6 months. But as Mr. Tooman told me when I spoke to him, that's not such a shabby return. You're still going to get around 5.34% if you buy by the end of April and you hold it even for a year. And that compares pretty much on par to what we're seeing with credit card, with the high yield savings accounts and also CDs and money market accounts right now.
So Carrie, given all of that, I'm sure though that there are some drawbacks that everyone needs to be aware of when it comes to I bonds. What are they?
Yeah, there definitely are. Not everyone's as big a fan as I might be about these. The two big things are you are limited to the amount you can buy. So $10,000 is in general the most you can buy every year. So for some people that's a turnoff. The second thing is you actually do need to hold them for an entire year. You can't cash in a year until a year is up. So that can be, if you don't want this for your emergency fund, right? And the third piece of it is that if you cash out before 5 years, then you lose 3 months of interest. So, that's why I said when Mr. Tooman ran that number for 5.34% for an annualized yield for a year, he was already factoring in that you were cashing out in a year under that 5-year limit. So he accommodated for that in his calculation. But I think people need to be aware of that.
All right, Carrie Henning, great stuff. Thanks so much.
Thanks.
Well, the cost of childcare is soaring, up 26% in the last decade. This is according to the latest numbers here from the White House. Well, President Biden, he wants to change that. Ahead of a reported re-election announcement, President Biden is putting child and elder long-term care affordability in the spotlight, signing an executive order this week directing federal agencies to find ways to make care cheaper.
Right now, the cost of care is too high for seniors in nursing homes, for working families with young children. Pay for care workers is too low. We should have no one should have to choose between caring for the parents who raise them, the children who depend on them, or the paycheck they rely on to take care of both.
Well, our next guest was at that signing ceremony yesterday. Joining us now is Ann Hedgepeth, Childcare Aware of America policy and advocacy leader. Ann, it's good to see you. And that executive order that was signed includes more than 50 directives in order to fix the current system. Let's just take a step back here. How dire is the current situation when it comes to childcare and elderly care here in the U.S.?
Yeah, I think many of us know just from talking to our friends and our family or living through it ourselves that the price of childcare is too high. It's on average over $10,000. And of course, in many areas of the country, every year families are putting even more than that to their childcare expenses. On top of that, our analysis found that there are 3.6 million, there's a gap of 3.6 million slots. That means the demand is higher than the supply currently provides for. So even if you want childcare and you can afford childcare, you often can't find childcare. And that's a big issue for parents. It's a big issue for employers, and communities are really struggling with that. We want to make sure that families can find the care they need and that that's done with fair compensation and robust investment in our childcare system.
And presumably an issue for this entire country. What's the impact on our workforce?
Sure. We know that we see overall lost earnings and lost potential earnings because there are workers who aren't able to be a part of our workforce. They're stopping out, dropping out, or experiencing time away just because of caregiving needs. That impacts all of us, not to mention the fact that so many families across the country are tapping into their networks, their friends, their families, their neighbors to piece together a childcare puzzle. Ideally, that wouldn't have to be the situation. Families would be able to choose the childcare that they want for their child when they need it, and we'd make sure that we power the workforce that takes care of all of our children so that they can invest in high quality care and we can set children up for success.
And what about the funding for all this? Because this executive order, according to the Biden administration, doesn't require any new spending. So how are some of these changes? Who's paying for that?
Such an important question, and something the Biden administration has been very clear about. These directives are critical. They let us make the most of our existing childcare programs. They'll make it so that the federal workforce and the federal agencies are model employers, and they'll even invest in some of the needs of military families. But at the end of the day, we will still need Congress to do their job. They have to fund these programs, and they can't roll back their investments in childcare and early learning. We would see cuts to programs at just the time when we need more investment. So while these directives are going to cut through red tape or even make the most of existing policies, we're also going to need to see additional funding come from Congress.
But this is, of course, at a time where both parties even admit it's time to begin to cut this budget. Now, primarily, that's an argument you hear from Kevin McCarthy and Republicans. But where might this money come from?
At the end of the day, our budgets as a country are a representation of our priorities. You've heard the president say that, and I think it's very clear that this administration sees childcare as a priority. Childcare of America completely agrees. And so when it comes to figuring out our budget this year and funding programs, there may be opportunity for cuts in some places, but the last place we should be cutting is where it comes to the basics of family budgets and investing in our children.
And are you confident that this executive order is really going to make a difference? Because some of the criticism, I don't know if I could say criticism, but some of the thought process out there is that President Biden is laying this out. It's not going to make a huge difference, and it's all part of this possible re-election here that he could be seeking in 2024.
Well, it's wonderful to see anyone prioritizing childcare, and I think that's responsive to what families are calling for right now. To the extent that his administration can issue directives, make clear to states who are implementing these policies, or even improve their internal policies, yes, there could be some immediate changes for the federal workforce and even for families and providers whose states might then adjust the policies they oversee because the federal agency told them to. I'm hoping we'll see some of those shifts. We may also have a longer timeline on other things, but we need to get started now. So even if there are regulations that have to change, let's get that process going, and let's make sure that we're thinking towards the future of our childcare system.
Certainly is things that needs to be changed. A very, very critical issue here facing our country. Ann Hedgepeth, thanks so much. Well, stick around as Dave is going to chat with the CEO of the Seattle Kraken here of the NHL, coming off their first ever playoff win. We'll be right back.
The next after the call zeroes in on Tesla, ticker symbol TSLA. We're going to be tracking the tick by tick after hours when the earnings report drops. Brad Smith, Brian Sozzi.
I am locked in on if Elon Musk, the CEO of Tesla, is even going to be on this call. It is no guarantee that he will be, but he better be on this call. I need to know from him how much money Tesla made during a quarter where they've been slashing prices so people buy their really expensive EVs.
We've already got some of the delivery and production numbers to our benefit. However, the big question on where that margin, where the profitability is going to maintain itself and what the outlook for the company looks like, especially as they're netting some new contracts to make sure that they're building out more factories internationally to deliver on the electric vehicle demand right now. Got my gold bricks ready, just in case.
Yeah, I don't know what Brad is looking for besides gold bars. I'm focused on how many times Elon Musk mentions AI, that is artificial intelligence. Brad, I'm saying he's going to mention it 52 times.
I don't know why I have these gold bars here, quite frankly. He's really more focused on Dogecoin anyway. So So it's not so much about the digital gold that Bitcoin is, even though Tesla did hold that for quite a while on their balance sheet. Maybe we get an update on if they're inclined to get back into that. But yes, AI mentions at least 7, for sure.
After the call on Tesla, Yahoo Finance. Be there, be square, be electrified.
Only one NHL team can say they've never lost a playoff game. The Seattle Kraken are now 1-0 after shocking the hockey world, defeating the defending Stanley Cup champion Colorado Avalanche in Game 1 of their first-round series, giving the second-year franchise its first ever playoff victory. Joining us now to talk about that in the business is Seattle Kraken CEO Todd Leiweke. Congrats, sir. Is this happening even ahead of your own optimistic timeline?
Well, I hadn't really thought about us being the only team to be undefeated in the playoffs, but I'll take it. We began this journey some years ago, and we really had an amazing challenge of trying to fix the arena situation in Seattle. And it had really been a challenge for many, many, many years. At the end of the day, a privately financed facility fixed it. It's the most sustainable arena in the world. We argue that it's the most beautiful arena in the world. And it's home to the Seattle Kraken. And I think the players have fallen in love with our city and playing for this team. And thus, we've made the playoffs in our second year.
All right, so let's zero in on that arena, Climate Pledge Arena. You're home to some massive corporations, Microsoft and Starbucks and Amazon, just to name a few. How about Boeing? So why name it Climate Pledge Arena and not get several $1 million a year on that licensing name there? And how is that arena rebuilt, not just a team, but a city?
Well, we think the arena's had a huge impact on our community. We're right in the heart of Seattle on this beautiful Seattle Center campus. But why the Climate Pledge? Because mission matters, and mission matters in everything you do. We saw it with our team last night. And when you have mission, our mission is to be the most sustainable arena in the world and show the rest of the world it's possible. At the end of every year, we will certify as a zero carbon building. We will buy some carbon credits, but we are leading the way. No fossil fuels, no gas. We serve brilliant food, but it's all cooked with electric. And at the end of every event, 99% of the waste coming out of the building is either going composting or recycling. It's mission, and mission matters.
Bravo. And I know Earth Day is right around the corner. So big picture, what's been the key in building the success? You started in a global pandemic. You've established a rabid fan base from really the first drop of the puck. How do you do it so fast?
Well, I've been in sports my whole life. I've had a really fun career, but never would I have ever thought that we would have launched this team in the midst of a global pandemic. And many, many, many people dealt with it. It impacted many businesses, but starting something of this magnitude in the midst of a global pandemic, you know, our fans showed up, but they really were muted with masks on. Kids couldn't come to games. Players couldn't meet other families. It was an enormous challenge, but big ideas sustain themselves even in the most challenging times, and that's really what happened for us. This is an idea whose time has come. We're proud of what we've done in Seattle, and it's not just on the ice. It's a lot of community activism and things like the Climate Pledge and our work with youth, homeless youth. We've really chartered this team to be a community activist, and we're super proud of the results early on.
Yeah, you mentioned you've been around sports a while. Indeed, you held that role at the Tampa Bay Lightning. You were the CEO of the Seattle Seahawks, the CEO of the NFL, part owner of the Seattle Sounders. What's the common thread there among those experiences, and what's the lessons you've learned that you applied here with the Kraken?
Well, I'd say the primary mission for me is serving fans and serving community, and I love doing it. Last night, we're facing a great team here. We got a long way to go. They're the defending champs. We don't take anything for granted, but last night was a little bit of payback for our fans. And in all of my roles in sports, I've loved serving fans. Fans believe that, yeah, they give you money for tickets, but they really give you your time. And the most important thing they give you is their passion. And the passion that our fans have for what we're doing has really fueled us. And it's helped us get through all sorts of incredible challenges and not just launching this team, but opening a new building. And I have that great passion for serving fans, and we're on the way to doing that here.
You also want to serve fans in an entirely different sport, albeit the same arena. Your mayor, in fact, said that he thinks you can attract an NBA team in a shorter timeline than 5 years. What's the likelihood, and what sets Seattle apart from other cities like Las Vegas?
Well, I was here. I was CEO of the Seahawks and saw the Sonics leave. It was just incredible. Here's this community with so many assets and resources and companies, and the Sonics left. And that really, the root cause of that was the arena situation. Government wasn't going to fund a new arena. They were wary about investing in arenas and venues. And so it took a private sector solution. And we invested $1.2 billion in partnership with OVG. And actually my brother, and his incredible vision that the historic arena there, the Seattle Coliseum, which was built for the World's Fair in 1962, could indeed be saved. Many people said it couldn't. Other engineers said it could. We chose to listen to the people that said it could. And now anything's possible. And that's not only home to the Kraken, it's home to the Seattle Storm. We're so proud of our partnership with the Storm. It's home to amazing music. And if you believe in the business you're in, which I do, we bring joy to our community. And every man, woman, and child in our community will have reason to come under that roof and to celebrate something, whether it be Bruce Springsteen, the Seattle Storm, or yes, your playoff participating Seattle Kraken. Sounds pretty good.
It does, unless you're a Denver native and a fan of Sakic and Forsberg and Waugh. It was a tough one last night for me, Todd.
Are you a Denver guy?
I'm a Denver native and an Avalanche fan.
Let me tell you, it's easy being an Avalanche fan. It's been remarkable what Joe Sakic's done here with the team. We have great respect, and we're in for another challenging game tomorrow, but a moment of joy. Let me live the day, just enjoying what happened last night.
Indeed. Best of luck, sir, and enjoy that first home playoff game this weekend. That should be quite a scene. Todd IXIC, good to see you, sir. Best of luck. All right, coming up, we check in on the latest trending tickers moving after hours after the break.
Let's take a look at what's trending after hours. We got 4 stocks here for you: Tesla, IBM, LV, Sands, Las Vegas Sands, and Alcoa. Kicking it off with Tesla now off nearly 4% in extended trading. The company reporting its latest results here, a miss on both the top and bottom lines. EPS coming in at 85 cents. Gross margin also a bit light there, 19.3%. The estimate was for just over 21%. We know that this key metric is going to be or was closely watched here, given the fact that Tesla has cut the prices of its vehicles so many times here since the start of the year. Free cash flow also falling to $441 million, way below consensus estimates here, off about 80% on a year-over-year basis. You're looking at Tesla in the red in extended trading year-to-date, gains of just about 46%. Flipping it over to IBM, that stock actually moving to the upside, up just about 3% in extended trading. Now, the company did report mixed results. Its profit beat, but sales coming in just a bit light, $14.25 billion, just shy of what analysts were looking for. Software revenue was better than expected, $5.9 billion. The company also saying that they see full-year free cash flow of $10.5 billion. That was also slightly ahead of where the street had it. Year-to-date, though, IBM in the red, off just about 10%. Taking a look at Las Vegas Sands, that stock up just about 4.5% in extended trading. Strong report here from the company. They are seeing, quote, robust recovery in travel, also in gaming here. Net revenue, $2.12 billion, a beat there for the company. Again, shares moving up almost 5%. And let's take a look at Alco, another stock that's on the move here after hours, off just over 2%. Now sales declining 19% on a year-over-year basis. Higher prices in alumina, also aluminum, not enough to offset the drop that we saw in shipments for those two products here. You're looking at Alcoa shares off just about 9% since the start of the year. Well, that'll do it for us today on Yahoo Finance Live. Be sure to tune in tomorrow for our exclusive interview with Cleveland Fed President Loretta Mester. That, of course, will start at 4 p.m. Eastern Time. Have a great night. We'll see you tomorrow.